Here we have your second installment of lectures on the basics of the exchange rate. We had covered some of the basic definitions. We'd looked at how exchange rates work, how we're going to notate nominal exchange rates, and we had also looked at a trade-based supply and demand model of the exchange rate. We're going to continue with that. That was our first model of the exchange rate, and we're going to look at two more models of the exchange rate. One of them is uncovered interest parity. This is going to be a short-run view of the exchange rate. And the other is going to be purchasing power parity, or PPP. This is also known as the real exchange rate, and this will be our long-run theory of the exchange rate. So keeping your notes organized, we have three different models of the exchange rate. We have the exchange rate market, we have uncovered interest parity, and purchasing power parity. Let me just talk a little bit about the context of the way that I'm presenting this. When we looked at the supply and demand model of the exchange rate market, I asked you to take a fairly simplified approach to getting familiar with it by allowing you to kind of eliminate most of the financial variables from supply and demand and to focus instead just on the trade motivations behind supply and demand for foreign exchange. But, you know, in the era of globalization, probably the most defining feature of globalization has been the overwhelming volumes of financial capital flows moving around the world. So we're going to use our second theory of the exchange rate, uncovered interest parity, and instead of having a trade-based focus in the determination of the exchange rate, we're going to look instead at a financial capital flows focus on the determination of the exchange rate. And one of the reasons we'll do that is we're going to move ahead later on into currency crises and debt crises. And these crises are usually short-run business cycle phenomenon that have a lot to do with volatility of capital flows rather than volatility of trade. So we want to focus on the financial aspect, and looking at uncovered interest parity allows us to do that. Let's get started. I think it's presented here in a fairly simplified fashion, and we'll kind of grow to find our ultimate equation that defines uncovered interest parity. A quick note to all of you out there, we will be using uncovered interest parity frequently throughout not only section 1, but section 2 as well. And so you will want to spend time getting familiar with it because it will come back to haunt you. So without further ado, let's get started on uncovered interest parity. So this is a determination of the exchange rate in the short run. Let's think a little bit about this. When money is internationally mobile, investors will search the world seeking the highest rate of return for a given risk level. Money will flow out of countries with low rates of return, and it'll flow into countries with high rates of return. So what we have is capital scouring the globe for high rates of return, flowing where those rates of return are the highest. Let's take a very simplified approach to looking at this. You could use any numbers you want to. We'll use the simplest ones just so we understand the economics behind this rather than the arithmetic of all this. So let's go ahead and take $1 and invest it for one period. If it is invested domestically, then that rate of return will be the $1 multiplied by 1 plus the interest rate. So at the end of one period, you get the $1 back, and that accounts for the 1 in that equation. Plus, you get some percentage of that $1 in the interest, and that's the I there. So I here is the domestic interest rate, your rate of return invested domestically in domestic bank, or you could consider this to be a domestic asset of some kind, would be 1 plus the interest rate. Now, the alternative is to invest that dollar abroad. And so we're looking here at the rate of return from investing abroad. Let's walk through it. You've got $1 and you're investing it in France or Germany or somewhere, right? So the first thing you have to do is convert it into foreign currency. So we'll take that $1 and we'll multiply it by 1 over E. In other words, we'll divide it by E. And that converts the dollar into foreign currency. So once we've taken the dollar, multiplied multiplied it by 1 over E. Say it's the, dollar-euro exchange rate. We've now converted that into a euro-denominated dollar. Yeah? So we will then deposit that euro-denominated sum in a foreign bank, some European bank, and it will earn 1 plus the foreign interest rate, where IF is the foreign interest rate. So all this is denominated in foreign currency. Now, what we're looking at here is a dollar invested domestically and then a dollar invested abroad. So these are interesting because we can't really compare them at this point in like currency terms. Your dollar invested here is denominated in dollars. Your dollar invested abroad, in our little example, is denominated in some other currency like euros or what have you. So we're not really comparable just yet, but we'll work with that. But what we have here is basically the idea of this is how we'd calculate the differing options available to an investor investing either domestically or abroad. The investment must be converted back into U.S. dollars for comparison in like currency, and obviously you'd want to repatriate your profits from your euro investments at some point, so you want to know what they look like in dollar terms. Also, we're thinking about, hey, what is the dollar rate of return on investing domestically versus abroad? So we want to be able to convert that foreign investment back into domestic currency. Since the investor doesn't know with certainty what the exchange rate's going to be one period into the future, he or she has to form an expectation of it. So we will let capital E be the expected value of the future exchange rate, in this case, one period forward. So the return on foreign investment denominated in expected future dollars would be 1 divided by the current exchange rate and then grown at the foreign interest rate and then converted back into dollar terms by multiplying it by the expected value of the future exchange rate, capital E exchange rate. So now we have something that's comparable. We have a foreign and a domestic investment both in dollar terms, and we can compare which one is more attractive. We would, of course, invest abroad if the money that we would earn abroad would exceed the rate of return domestically. And so that just says, hey, let's look at the dollar value of the foreign investment. Let's compare it to the domestic investment. If the foreign investment is higher, I'm going to invest in Europe rather than in the United States. Now, what that means is that capital will flow out of the United States and it will flow into Europe. As money pours out of the United States, nobody appreciates the dollar. Everyone appreciates the euro. And when you don't appreciate a currency, it depreciates. So the US dollar will be depreciating as capital flows out of the country. Now, the euro will, of course, be appreciating. Here, investors appreciate the euro very much because of its high rate of return, and when you appreciate a currency, yep, it appreciates. Our alternative to this is, well, what about investing domestically? If the foreign rate of return is less than the domestic rate of return, then you'll want to invest domestically, and Europeans will also want to invest in American-denominated assets. So this would entail capital inflows, and money pours into the country. Everybody appreciates the U.S. dollar, and so it will appreciate. Now keep in mind that as money flows out of Europe, their currency will be depreciating. With just a little bit of algebra, we can work with those expressions and put them in a more convenient and simplified fashion. The above conditions can be reduced to the following. Invest abroad capital outflows if the domestic rate of interest is less than the foreign rate of interest plus the expected depreciation of the domestic currency. Now let's just take a moment and look at that. We have rearranged the foreign rate of return and domestic rate of return. Obviously, we've gotten rid of the ones. It's just a little bit of algebra to get into this expression. But what we have is that basically the concept is your rate of return domestically is the domestic interest rate. Your rate of return on foreign deposits is consisting of two components. One of them is your money will grow at the foreign rate of interest. But there's another component to the foreign rate of return, which is the potential that your domestic currency depreciates vis-a-vis the foreign currency. If the euro is appreciating vis-a-vis the dollar, another way of saying that is the dollar is depreciating vis-a-vis the euro, then holding your money in euro makes sense. The euro is gaining in value, and you'll make an additional rate of return based off of the appreciation of your foreign currency holdings. Another way of saying that, of course, is you'll make additional rates of return based off of the expected depreciation of your home currency if it is the case that you're holding foreign currency assets. So the second part of that component is the rate of depreciation of domestic currency. You can also think of it as the rate of appreciation of your foreign currency. So two components to the foreign rate of return. One, how much am I going to make off of interest? And two, how much am I going to make off of appreciation of the foreign currency or expected depreciation of the domestic currency? So there are two components there. And suppose that you were earning 3% in interest and you expected the US dollar to depreciate by 3% vis-a-vis the yen, then holding yen would entail not only a 3% growth in interest, but also a 3% growth in appreciation of yen, giving you a total of a 6% rate of return relative to whatever the domestic interest rate was. So keep in mind, the foreign rate of return has two components, one of them the rate of interest, and two, the expected depreciation of the domestic currency. Our second statement here just reiterates the direction of capital flows. In the alternative case, we would, of course, invest domestically, and foreign money would pour into the country if the domestic rate of return exceeded the foreign rate of return. And so money is essentially sloshing around, changing exchange rates as long as these rates of return differ. When money is moving around, we don't yet have an equilibrium. So we want to find out what equilibrium condition we need to apply to these equations in order to find a value of the exchange rate that gives us an equilibrium. But before we get that far, let's just do a simple numerical example of the aforementioned dynamics and equation. Suppose that the interest rates are 5% on domestic assets, and you want to potentially invest for one period $100. So the domestic rate of return on that $100 investment would be $105 one period in the future. Your alternative to this investment is to invest abroad. Investing abroad entails an interest rate of 2%. Now, that might make you think I should invest domestically, but remember there's another component to the foreign rate of return. Suppose also that the current exchange rate is 1.2, and so your $100 is worth 83.33 units of foreign exchange once it's been converted into foreign currency. Yeah, investing at 2% will provide 85 units of foreign exchange after one period. Now, if the exchange rate doesn't move at all and we convert back into US dollars that 85 units of foreign currency, we're going to use the same exchange rate that we used when we moved the money abroad. We're going to convert it back at 1.20. That would give us $102. Well, this makes sense, right? Our investment in the asset abroad grew at 2%. There was absolutely no movement in the currency, so we didn't get any expected depreciation, and our overall rate of return is essentially 2%. Under these conditions, right, obviously the domestic investment would look preferable to the foreign investment. Let's change that assumption of the exchange rate not moving or being fixed and assume that the US dollar depreciates over that period of time. It's depreciated enough so that now the exchange rate has moved from 1.20 to 1.32. You'll note that this is a 10% depreciation. Now, when we're converting back into US dollars, our 2% growth on our foreign investment. Remember, we had 83.33 units of foreign exchange. It grew at 2%. We had 85 units of foreign exchange. So at the end of that period, we had 85 units of foreign exchange, and we're now going to convert that back into dollars using the future exchange rate of 1.32. This provides us with a $112.2 denomination. Your overall return here has been that you invested $100, and at the end of the period, you acquired $112.2. That overall rate of return is calculated for you. It's just the percentage change in the growth of your asset, and the answer is 12.2%. This 12.2% is approximately the 2% rate of interest plus the 10% rate of depreciation. Given the expected rate of depreciation of 10% and the overall rate of return on foreign investments of 12%, you can see that clearly investing in the foreign denominated asset or bank account is preferable to investing in the domestic one. Even though the domestic interest rate is higher than the foreign interest rate, we have to also take into account the expected rate of depreciation of the currency. Investors would rather turn their $100 into $112 than into $105, and so the foreign rate of return will exceed the domestic rate of return. Capital will flow out of the country, and the currency will depreciate. Our next stage is to recognize that as capital flows move in or out of a country, it is impacting the current exchange rate. And so that will in turn influence the expected rate of depreciation that would be taking place. Let's go through an example. Suppose that the domestic rate of return is less than the foreign rate of return. Okay? As you know now, capital will be flowing out of the country. The supply of dollars will increase relative to foreign exchange. The demand for dollars will decline. And so this will entail a depreciation of the current rate. So if you turn your attention to the expected rate of depreciation here, that E, both in the denominator and in the right-hand portion of the numerator, that's the current spot rate. And as capital flows out of the country, that's depreciating. So it's going up in value, from 1.20 to 1.30 to 1.40. So the denominator of that expression is growing, and that will force the value of the fraction to go down. In addition, the numerator, it's a difference, and the second term in that difference is rising, narrowing the value of the numerator. So as the spot rate depreciates, the numerator is getting smaller and the denominator is getting larger, and the overall term, the expected depreciation of the currency, is going down or getting smaller. Consequently, this will overall bring down the foreign rate of return until it is again equal with the domestic interest rate. To give you a simple example, take our last example, The domestic interest rate is 5%, the foreign interest rate is 2%, the expected depreciation of the currency is 10%, and capital begins flowing out of the country, depreciating the currency now so that the expected future depreciation is not quite so great. As capital flows out of the country, the expected depreciation started out at 10%, will move to 9%, will move to 7%, will move to 6%, and so on and so forth. In fact, the expected depreciation will continue to fall until capital stops flowing out of the country. In this example, the expected depreciation would have to fall to 3%. Now, at 3%, the foreign rate of return would be the 2% on the bank deposit plus the 3% expected depreciation, totaling a 5% rate of return on foreign deposits, which would be equal to the domestic rate of return of 5%. At that point, capital would no longer flow out of the country, and the currency would no longer depreciate. So after capital has stopped moving, we've stopped seeing movement in the exchange rate, and we've found an equilibrium exchange rate. That equilibrium exchange rate is the one that balances out the foreign and domestic rate of return. And that's what we're looking for with uncovered interest parity equilibrium, where I is equal to I prime plus the expected depreciation. When that is true, capital has stopped flowing and you found a stable value of the exchange rate. This will be the equilibrium sort of condition that we use throughout the rest of the class. I want you to note that we're going to be getting into some fairly complicated things, and one of those is going to be exchange rate regimes in which the government has chosen to use the central bank to fix the value of the exchange rate. So there's a little note at the bottom of the page, and occasionally you'll see these on slides. These are hints as to the way that what we're covering will apply to more advanced topics later on, right? The note says, if the exchange rate is constant or fixed, then how are we going to get to interest parity equilibrium? Well, the answer is, if the exchange rate's not moving to generate that equilibrium, then the interest rate must move to generate that equilibrium. In this example, if the exchange rate were fixed, no one would be expecting it to depreciate in the future because it's guarded by the central bank, in which case that term, expected depreciation, would be zero. And if that were the case, the 5% domestic rate of return would obviously beat the 2% foreign rate of return. Capital would flow out of that country until interest rates increased to 5%. We'll talk about the implications of a fixed exchange rate for monetary policy and monetary autonomy later on, but I want to give you a little note or a little hint as to how this might apply to more advanced topics that we'll be covering in a normal semester in a week or two, in a condensed semester in a day or two. Now we have concluded our theories of the exchange rate in the short run, and we're going to move on to talk about the exchange rate's behavior in the long run. This is going to be purchasing power parity and the real exchange rate. The real exchange rate measures the value of currency in terms of real goods and services as opposed to the nominal exchange rate that we'd been looking at before. The real exchange rate is adjusted for inflation. Our real exchange rate will be denoted by a capital R, and it is equal to the nominal exchange rate multiplied by the foreign price level divided by the domestic price level. Misalignment in the real exchange rate creates opportunities that change price levels and or nominal exchange rates in countries. Note that misalignments of the real exchange rate may cause external imbalances, trade surpluses, and trade deficits, if you will. Let's take a look at this. The real exchange rate. Suppose that the price of a sweater in the United States is $40 US, and that the price of an equivalent sweater in France is 50 euros. Now, I could ask students, which one's more expensive? And students won't be able to answer that question because they're comparing two different nominal values, $40 versus 40 euros. So to know which one's more expensive or which one you'd rather buy, we have to compare these two goods in equivalent currencies. In order to do so, we need the nominal exchange rate. And for this exercise, we're going to choose a nominal exchange rate of 1.2. Now, that's the exchange rate between the euro and the dollar, right? So it's the number of dollars that it takes to buy a single euro. And consequently, if we take the 50 euros and multiply it by the exchange rate of 1.2, what we will have is the price of a French sweater in US dollars. Then we can compare that to the price of a US sweater, which is already denominated in US dollars, and figure out which one we're going to buy. But before we do that, let's calculate the real exchange rate. Our real exchange rate is 1.2, the exchange rate, multiplied by the euro price of sweaters, 50, and divided by the US price of sweaters, 40. Our real exchange rate has a value of 1.5. Note that you get a value of a fraction that is greater than 1 when the numerator is bigger than the denominator, right? So as soon as this fraction goes over 1, you know that the numerator is bigger than the denominator. And the numerator has two components, remember, the nominal exchange rate and the foreign price of sweaters. So the real exchange rate's 1.5. Let's kind of look at this in simple terms. If you wanted to buy a sweater in France, how much is it going to cost you in US dollars? Well, you got to get 50 euros to get that sweater, and you're going to need to spend $1.20 to get a euro. Each one of those euros is going to cost you $1.20. So overall, the US cost of buying a French sweater will be $60.67. Well, the US price of buying an equivalent sweater is only $40. Why would I be buying a French sweater? The answer is you wouldn't be buying a French sweater because US sweaters are cheaper in real terms. Well, if you're sitting in France, why would you be buying a French sweater? I would just import one from the United States because it's going to be cheaper in euro terms. So thus, the French demand for US sweaters will increase. Everybody's going to want to be buying US sweaters. Maybe you buy them in America and you sell them in Europe at a bit of a profit. And nobody in the U.S. is going to be buying French sweaters. They're all going to be buying U.S. sweaters, right? So there's dynamics in the market. There's movement in the markets. And because of this movement in the markets, something's got to give, right? And there's a couple things that can give here, right? So this is going to continue, this excess demand for U.S. sweaters, until there's no difference between the price of U.S. and French sweaters. So what could happen? Well, one, all of this demand for U.S. sweaters could push the price up over $40 and continue to drive the price higher until the U.S. price of sweaters was equivalent to that of the French sweaters. So that's one of the things that could happen, is this could impact the domestic price level of sweaters because of all the additional demand. Now, that price of sweaters would continue to rise until, again, there was no reason to buy more U.S. sweaters. Yeah? And so that would drive our real exchange rate to 1. Another thing that could happen, of course, is that since nobody's buying French sweaters and everybody's buying American sweaters, that the French price of sweaters would have to fall. And so you'd see the numerator in our real exchange rate go from 50 and start dropping, and that price would continue dropping until, again, there was an equivalence of cost between French and American sweaters, i.e. the real exchange rate was equal to 1. And a third thing that could adjust to cause this would be that the nominal exchange rate would move. Yeah. What we'd see here is a tremendous demand for U.S. dollars in order to buy U.S. sweaters, which would mean a surplus of euros and a shortage of dollars. Everybody appreciates the dollar here, and so the dollar appreciates. When the dollar appreciates, the nominal exchange rate falls from 1.2 to 1.75 to 1.65, and it will continue to fall until the real exchange rate is equal to 1. Oftentimes, when we're analyzing short-run dynamics, we tend to fix price levels and allow things like exchange rates and interest rates to vary because, of course, the market for sweaters is huge and foreign demand won't necessarily comprise a large enough impact to change those prices. But the exchange rate can be quite volatile and respond very quickly to undulations of supply and demand. And so here we have one theory that if we fix the domestic and foreign price level, that the nominal exchange rate will have to vary in order to cause the real exchange rate to be equal to a value of 1. When we have found a nominal exchange rate that gives us a real exchange rate equal to 1, then we have found a long-run value of the exchange rate. So that's going to be the equilibrium you're looking for long-run analysis. Pick the nominal exchange rate such that the value of the real exchange rate is at 1. What does that mean? Well, in the numerator, we had the U.S. price of buying foreign goods, and in the denominator, we had the U.S. price of buying U.S. goods. So the price of these things has to be the same, Otherwise, people would be buying and selling and changing exchange rates, and hence the purchasing power parity, right? The cost of real goods across frictionless trade between countries or regions has to have no difference. It has to be equivalent, right? Otherwise, you'd be buying and selling and changing prices. So the real purchasing power of the euro is too strong in this example. The real exchange rate is 1.5, and the real exchange rate from the advantage of the United States, which is the one we calculated, is obviously too weak. It's too depreciated. It should be equal to 1, but it's equal to 1.5, right? As the demand for U.S. sweaters increases, the exchange rate must appreciate until the real exchange rate is equal to 1. In this example, the exchange rate will stop appreciating when the real exchange rate is equal to 1. And a simple calculation allows us to determine what that nominal exchange rate must be. It is 0.80. So 0.80 would be the exchange rate that would allow our real exchange rate to be equal to 1. It is the equilibrium value of the exchange rate in this example. The math that we used to find that, pretty straightforward. We took our $40 price of sweaters and our €50 price of sweaters, and we said, all right, we're not going to change those prices. We're going to assume those are fixed. And then we said, hey, let's pick a variable like the nominal exchange rate E and ask ourselves the question, what does E have to be such that $40 is equal to E multiplied by €50? That is saying, hey, we want to equate the domestic price of sweaters with the dollar price of foreign sweaters. And so we divide these two out, and we get E is equal to 0.80. So pretty easy for you guys to do mathematically. Just remember that the long-run equilibrium value of the real exchange rate is 1, and that the real exchange rate is the dollar price of foreign goods relative to the dollar price of domestic goods. Now, if we plug in a nominal exchange rate of 0.80 with our given prices of euro and American sweaters, we find that we found the proper exchange rate. It's equal to 1. So how good is the real exchange rate theory at predicting what equilibrium values of the exchange rate should be? The theory relies on a lot of assumptions, particularly about frictionless trading between countries, no tariffs, no taxes, no barriers, no other costs, right? Such that it is absolutely costless and frictionless to trade between two countries, and arbitrage will cause the real exchange rate to be equal to 1 rather than anything else. But as you know, the real world contains a tremendous amount of these sort of frictions, and so using the real exchange rate as a theory for speculating in exchange rate movements needs to be enhanced by a more nuanced and deep model that applies to each country if you're going to have any degree of predictable accuracy speculating on exchange rate movements on the basis of trying to keep R equal to 1. That said, in 1992, George Soros made $1 billion in a single bet when he was betting against the pound sterling. And the theory that he was using to bet against the pound sterling was the idea that, hey, this exchange rate has to conform to the real exchange rate, and it currently isn't. He was right about his bet, and he did pretty well on this. Little note at the bottom of the page there. Sometimes I will talk about them, sometimes I won't. This one I'll talk about just very briefly. The note says if the exchange rate is constant, then prices must adapt. So we're going to be talking about misalignments of real exchange rates. And when we're in a situation where the country has a fixed exchange rate, well, we'll see a lot of pressure build up on the nominal exchange rate. But if the nominal exchange rate doesn't move, we're going to have to see domestic price changes. This becomes particularly interesting in the case of the European Union, where they had the recent euro crisis, and each of these countries, of course, has a fixed exchange rate in the sense that they're all using the euro rather than their own domestic currencies. So we saw things like surpluses in Germany and deficits in countries like Greece. Those deficits would imply that something needs to happen to the value of the real exchange rate. And those deficits would imply that the cost of foreign goods was cheaper than domestic goods, so you start buying a bunch of foreign goods and drive up a deficit. In essence, the numerator was smaller than the denominator. Well, if there's no exchange rate because you are all using the same currency, the euro, then the only way to bring about an artificially strong real exchange rate is to bring down the domestic price level. Bringing down the domestic price level can happen in a couple of different ways. One of the ways is improvements in productivity. But improvements in productivity usually take a long horizon to implement and see the benefits from. A shorter way of bringing down the domestic price level is essentially to crush wages or generate some sort of recessionary force. And so when the exchange rate's gone as a nominal variable to sort of take pressure out of disequilibriums, then oftentimes other nominal variables like the price level have to move, and pushing those to move can require real changes such as falling wages and rising unemployment, which is exactly what was expected of Greece in order to bring their deficit down. Now, we'll talk about the political economy of that later because clearly Greek citizens wouldn't want to deal with crushing wage cuts and budget cuts and a long-term recession. They'd rather just renege on the agreement to be part of the euro and then all of a sudden just have a nominal depreciation and be back in business. But politically speaking, protecting the euro and its value is something that a lot of leaders in countries that were benefiting from the euro, such as Germany, didn't want to see happen. So there's a tremendous amount of politics in the choice of the exchange rate and agreements between countries that change the degree of flexibility and how to deal with the crises. In Greece's case, a lot of pressure was put on citizens to pay for the crises. But we'll talk more about that later. All right. That has been your lecture on the remaining theories of the exchange rate. I want to stop there because it's pretty good, pretty dense material, and give you a chance to study it before we move on to the next lecture, which we will do shortly.